to the Buy-to-Let Lenders discussion. I'm delighted to be joined today by two of the industry's heavyweights, that's Phil Rickards and Adrian Moloney. Phil is head of BM Solutions, which is probably the biggest mainstream buy-to-let lender in the UK. And Adrian is Group Sales Director of OneSavings Bank, which encompasses Kent Reliance, Interbay Commercial and Precise. So arguably the biggest specialist buy-to-let provider in the UK. So I'm delighted to have you both with me today, chaps. Thank you very much indeed. I'm going to start off with a big question, one that can't be avoided. Lots of elements to it. Basically, how do you think COVID-19, the pandemic, the lockdown, and unfortunately the inevitable recession are going to impact the UK buy-to-let market in the foreseeable future? And if I could ask that first to Phil, please.
Wow, that is a big question to get us going. I think before we look at the outlook for the buy-to-let market, it's probably worth reflecting for a second on the events of the last 16 weeks and the challenges that that's provided for everybody in the mortgage journey. Brokers have had their challenges, lenders have obviously had their challenges with site closures, there's the valuation issue, and it's been a really challenging period. But I guess the great news is that we've seen a very quick bounce back. We're able as lenders to put some emergency measures in place, giving our BDMs access to systems so they can support the processing units. And now we're seeing situations where phone lines are back on, valuations can be done. In our own business, our mortgage processing times are back up to near normal standards. So it's been a very quick turnaround, but definitely a really challenging period, and great work from everybody concerned. I think looking forward, buy-to-let has always proved to be incredibly resilient. We're definitely going to face into some short to medium term challenges as the true impact of lockdown emerges, and what unemployment will do for rents and how that will impact landlords. But the private rented sector throughout history has been through many, many challenges and has always bounced back. And there's nothing in my mind to suggest that it won't do that in the longer term. Landlords tell us they're in it for the longer term. They've got long-term plans. So I think, Paula, some short-term, medium-term challenges, but long-term, private rental sector's got a very important part to play in supporting the UK housing agenda.
So long-term and optimistic outlook from Phil there. Adrian, would you agree?
Yeah, I mean, there's probably not much more I can add to what Phil said. I mean, the buy-to-let market went into this pandemic as, I guess, a healthy patient. And I think it will come out of the pandemic in good shape. I mean, the buy-to-let market went through the last downturn. It was the first time really it was stress tested and came out very positively. To Phil's point, as we've all gone along this journey, we've started to see the reintroduction of physical valuations, which was really important for the sector, and demand for the products pick up with some gusto. The market seems strong. As an investment, buy-to-let still seems to be popular. The returns are good. I think going forward, of course, we are yet to see what the outcome to UK PLC will be in terms of how this pandemic has hit. But I think people will still want to rent property. They'll still want to rent good quality property. And I think the market's well positioned and is returning well as it goes at the moment.
So some good news there. You also both touched on people responding well and moving to the digital. The lockdown obviously has moved lots of things online, including this event and a lot of the work that's done at your companies. Do you think this shift will change the way that buy-to-let business is carried out in the long run, and might that have financial implications for brokers? I'll ask that to Adrian first, please.
Yeah, look, I think we've all seen the increased use of screen technology like we're using today, and I think the amount of brokers that probably see clients face to face was decreasing anyway. A lot of things would have been done over the phone. I think we'll see more use of this technology because it breaks down some of the I guess the unfamiliarity or some of the barriers that would just be there at the end of the phone. I really expect brokers to continue to utilise this as well. I think from a lender's point of view, when we start to look at the productivity and the support our sales teams can give, this bolts on nicely to face-to-face support and to telephony support, and I think provides an even better journey for the brokers that we deal with. I think in terms of technology and the way in which the market is processed, obviously going into this, there was a lot to talk about APIs and things like this, but I think that will continue that journey. But I think lenders will have to focus on how they support their clients first and foremost. I mean, you know, we got 75% of our workforce working remotely at the start of this pandemic because, of course, you want your staff to be safe. We had to get them out of the offices and working remotely. So we have to support that and then getting that back into the office, of course, when the moment is right. So I think that will be a key factor for lenders going forward. But I think, you know, I certainly see in the way my BDMs can work with brokers, there'll be face-to-face support, but when rather than doing 200-mile round trips to see someone, they'll certainly utilise something like this to have team meetings or meetings with their customers to discuss cases or discuss what criteria can do. So I think this period has almost propelled the use of digital technology a little bit forward.
How do you see the digital revolution being expedited by this lockdown, Phil?
Yeah, well, clearly I'm an expert in digital myself. That's very nicely put, Aid. I think this transition is happening anyway. It's just being slightly accelerated by the events of the pandemic. I also think fundamentally nothing has changed with the way that lenders transact mortgage business with way that brokers transact mortgage business with lenders. Everything was online anyway. Adrian's right, the efficiencies come with not having to travel. Everybody seems to have more time to do things properly. And that has to translate in greater efficiencies and ultimately, we hope, more business for brokers. And to your question, Paula, about financial impact, I mean, this can only come if we see a serious financial downturn. I think if we come out of this, as we hope we're going to come out of this, then I think everybody's got a little bit more time to do things properly and write more business. So it could be an opportunity for us.
Good to see the silver linings there in quite gloomy times. Thinking about the mortgage product criteria side of it, obviously we've seen a lot of changes recently. Going forward, what do you think the picture holds in terms of interest rates, LTVs, other income streams being taken into account in that whole criteria piece? Phil, how do you see that changing?
Yes, so I mean, clearly current trading conditions are a challenge. We're already seeing some tweaking of criteria around the fringes, and lenders have to naturally be cautious. You know, we've got to lend prudently. So naturally, we're going to have an eye on the events emerging from the pandemic. I think brokers will need to be patient through this time because they will see lenders treating scenarios differently. Every lender's got different policies and different views on things. I think once we've emerged from the pandemic and lockdown truly, and we see the true impacts on the economy and unemployment, then lenders will have greater consistency and a greater understanding of the challenges ahead. I think we're in for a bit of a short-term challenge on criteria. Interest rates don't look like they're moving anywhere soon, so that's got to be good for customers. And we don't see the same LTV pressure in buy-to-let as we see in the residential space. The closer towards 100% you get, then the greater the challenge if we've got some uncertainty around property prices. In buy-to-let, we tend to lend around 75%, some lending at 80 and some at 85. So you don't see that pressure on LTVs. So there's definitely some consistency there. I think a difficult 12 months ahead, but we'll come through this and lenders want to lend.
Yeah, which is obviously good news. Aid, you obviously have slightly different product sets, if you like, slightly different bits of the market. How do you see the whole criteria product side of it?
Yeah, look, I think one positive we should talk about where this is different to the last downturn is there's plenty of liquidity in the market. I remember back in 2008, as I'm sure Phil did, seeing products being pulled remarkably quickly because the actual liquidity wasn't in the market. That isn't the case this time round. You know, banks are well capitalised, and we're all here to lend money, which is a really positive bit. As Phil says, the LTVs seem to have settled at 65%. Obviously, we run a multi-brand strategy through the OneSavings Bank with Precise, Interbay and Kent Reliance, and we've managed to get product streams back in all of those. And that includes getting the larger HMOs out through the Interbay brand, which was really important to us to support that part of the market. And we've seen demand for those products straight away. I think in terms of criteria. It's probably set for a period of time, like what we're seeing at the moment. As Phil said, 75% always seems to be the majority of the normal in terms of LTV, and that's less of a pressure compared to what we're seeing with some of the higher LTV products in the residential market. I do think we have to be patient. As I said, we have to work through this period where there are payment deferrals to work through, where we're looking to see what happens with UK PLC in terms of jobs. But I think, all things considered, lenders have got back to this market well, and we're in a good place to deal with the short to medium term.
Yeah, thanks for that. You mentioned payment deferrals, so I'm going to move on to some questions that have been submitted by our delegates, if you don't mind. And the first one of those, I have professional and portfolio landlords who took out mortgage payment holidays. I've read some lenders are rejecting or suspending applications where the borrower has taken a holiday. How will mortgage payment holidays affect buy-to-let applications? Ada, can I come back to you on that one?
Yeah, look, I think I'm supportive of I do think is payment holiday the right word, but payment deferrals, because I think, none of us went into what we're experiencing now. It's no one's fault in terms of what's happening with their jobs, what's happening with their incomes. And I think from a lender's point of view, we'd much rather work with our customers than seeing them go into arrears for obvious reasons. I think in terms of how lenders will look at this is that they will look for more information. If you're lending to people, we want to lend responsibly. And if you're taking out a new mortgage, you want to make sure that that's affordable, or that in terms of a buy-to-let investment, that it's going to be able to be rented. I think we're at a stage now where estate agents are back, lettings agents are back, and it's easier to get a clearer picture for the demand for the properties that people are either refinancing or purchasing. Obviously, as part of the PRA rules, there's additional underwriting requirements that are required for the larger landlords, which includes cash flow forecasts and business plans, and a stress test on the buy-to-let portfolio in the background. So I do expect lenders to ask more questions about that, how landlords will cope with voids, and to make sure that they have the ability to cope with loans in the event of not being able to tenant properties. But I think the bit for the market is that we all dealt with the payment holidays, which came around quite quickly and had to build processes, and we are looking to work with our existing clients to make sure that we support them during this difficult period. And
Phil, do you agree with that?
Yeah, I think the bit at the end there is very nicely put. Our wider business, Lloyds Banking Group, has dealt with hundreds of thousands of payment holidays, and it came on us really quickly. So I'm particularly proud of the way we've handled that and supported customers. I think, just to briefly add to Aid's comments, we've got to put the payment holiday situation into perspective from a lending point of view. This was intended to help customers who are in financial difficulty, and the very term financial difficulty then poses a big question for a lender when they receive a new application form, particularly when it's an application for a property purchase. You do have to ask the question, why would somebody that's supposedly in financial difficulty look to be purchasing a new property? It just doesn't feel like the right time to do that. And I think all of this has to play out. As I said earlier on, once we're through this period, once we see the clarity around payment holidays ending, we'll be able to make more judgments. But to Aid's point, I think we will ask for more information in the short to medium term.
Thanks for that. Follow-up question from another delegate asked, what will the effect of a bounce back loan, that's a government guaranteed loan for small businesses and self-employed people up to £50,000, be on buy-to-let applications? Phil, could you answer that one?
I guess it's very similar to the debate we're just having. We're seeing more and more questions around, can a customer use their bounce back loan for a deposit for a new buy-to-let, which I find a strange question, given that the loan was intended to support a business or a small business through a difficult period. So again, that doesn't feel like the right use of those funds. And I think the same applies, Paula, probably in the portfolio landlord space in particular, where you've got customers who've built businesses. Again, I think we're going to be asking more questions around the stability of the business, particularly as we move out of lockdown, and for businesses that have taken bounce back loans.
Ada, anything to add to that?
No, only very briefly. We outlined our position on this because obviously, to some of our brands lending in the residential space, and we fully expect self-employed applicants or businesses to have taken out these loans. I think there was a raft of, if you like, discussion or trails on certain social media channels about people using these facilities for deposits on buy-to-lets. That's not something we would expect to see. When we went out to our broker partners and outlined our position on this, we would expect deposits to come from your own funds, as we would have done going into the COVID-19 piece. And I think lenders are, I think, on the back of that, what I would say as well is, what I've learned during this period is lenders have got very good at communicating with brokers, and brokers taking on board the communications that lenders have issued and understanding those.
Which has got to be another silver lining. If I could move on to another delegate question, which is a different market sector. How do you see the student-let market, and what's the current appetite to lend to this market while there's still uncertainty around whether universities will open as normal? Phil, could you answer that one for us, please?
Yeah, so we lend in the student-let space, and we're not seeing any early evidence of that part of the market struggling, but it could be a part of the market that struggles going forward, as will other areas of the market. Historically, that's been a good sector of the market for landlords with good yields, as have HMOs, for argument's sake. I think it's probably a little bit too early to assess the real impact of, where the damage will be done in certain sectors. But if one sector fails, another sector will prosper. And I think you might see landlords changing the use of certain properties where they might be struggling to get tenants in a particular sector. Personally, I think it's probably a little bit too early to assess.
Adrian?
Yeah, we obviously we do quite a lot in terms of HMOs and multi-lets, and actually through our commercial brand we'll lend up to 20 bedrooms in terms of those. I'm sort of cautiously optimistic about the student market because I think it performs well. So you often have a sort of guarantee back there for the student by the parents in terms of the rent, which gives the landlords additional comfort. But I think that sector of the market is quite specialist, and I think when you start to look at lending to the landlords in that space, you may want to see them having some experience. I think there's been a lot of talk about students and going back to education in September. I have 3 currently sat around my house that I really do hope go back in September. But I think what you might see in that, strange enough, in higher education and student world is more people take the option to go into further education. Depending what happens with unemployment or employment in the autumn, people may have to look at other options. And of course, what we're seeing potentially with things like foreign travel is that the opportunity for gap years, which I think have become more prevalent than when I was at college, may well decrease over this year. And you may see people start to take a step into looking at education as something to do sooner rather than later. So I think Phil had a very valid point in terms of, maybe the configuration of properties might look slightly different. But I still think that student accommodation and shared accommodation will be quite popular.
Excellent. On to a slightly different subject here from another delegate. What plans are there regarding cladding and buy-to-let lending policy around it moving forward? That one to Phil first, please.
So clearly the cladding position has proved challenging for the buy-to-let market, and I guess it's moved forward in the shape of the EWS1 form, which seems to be working better than it has done historically, but I think it's still causing some confusion. So the form is generally used by surveyors for properties that are over 18 metres, but I think the confusion comes in when it's requested on lower level properties. I think it's important to realise that this process has been put in place to ensure that customers don't end up with a property that could be worthless in the future, or they could be owning a property that they let to prospective tenants. That those tenants, quite simply, their lives are in danger because the building isn't fit for purpose, or there's a serious cladding issue. So I think it's a very serious issue that we've struggled to get right initially. We're working on it, and there's a lot of work going on behind the scenes. Lots of discussion at trade body level, industry level, about how we improve the process going forward. So it hasn't been an easy ride, I think we're in a much better place than we were.
Thank you. And Adrian, same question to you.
Yeah, I think cladding is a challenge for the lending industry as a whole, as opposed to just being limited to buy-to-let. And Phil and I both sit on IMLA, where this has been debated at quite a high level. I think the EWS one form has provided some consistency. I think applicants are starting to understand that, valuers are starting to understand that. But no lender wants to lend on something that isn't a property that's safe, first and foremost. And also from I guess a prospective purchaser's point of view, they want to make sure that that property is safe to let out, and also that it maintains the capital value that they're paying for it. But I think we've come a long way in a short time with the sort of introduction of the forms. And valuers are starting to understand this now, and the type of properties that it applies to. So I think it's over 18 metres is in general the rule that the form has to be applied. So I think gradual but good steps made forward in this space.
Thank you. Now, not many banks have fully committed to the buy-to-let limited company lending arena, says another delegate. Indeed, we've seen at least one large lender withdraw from the sector completely in recent weeks, as we know. How do the speakers see their own institutions tackling this area in the next year? That question to Phil first, please.
If I had £1 for every time I've been asked this question over the years, I would be retired by now, Paula. So we've set our stall out for a long time on limited company. Our business is very much focused on the traditional sector of the market, so that part of the market that's assessed by rental coverage ratios and stress rates. And we also work hard in the small to medium-sized portfolio. And we're trying desperately not to be all things to all men. And we see the limited company market as being a specialist part of the market, and there's plenty of choice out there for brokers and customers. I'm not saying it's never for us, but we're focusing hard on getting our proposition right in that core part of our business.
Thank you. And Adrian?
I always sit in these panels when Phil's on and wait to see, will I get the exclusive as to when his brand's going to come into this market? So I've probably had £1 for every time I've listened to him have to give a similar answer. But we're big supporters of that market through the 3 buy-to-let entities that we have. We see good demand from professional landlords or larger landlords still looking at either purchasing in a company name, and indeed for some that are looking to incorporate at the moment, because of course we're at the phase of, I guess, the tax phasing out for where people have had the right tax advice and it's applicable to them. They want to switch into a limited company. I think there's 16 or 17 providers out there. So as Phil said, quite a lot of choice, a lot more choice than when I joined OSB 5 years ago. I think there was about 4. So that market's grown. I think, despite the departure of one lender who actually I wouldn't have said actually was a big player in that market, the shape of the market remains robust and the choice for brokers and clients is there. I think what you mightn't see is that going into COVID, I think you may have seen some of the more medium-sized building societies look at the opportunities potentially for margin and growth of their buy-to-let business in that. But I think with what we've gone through over the last 16 weeks, they may stay looking at their core markets for a period of time, and perhaps you might not see as many entrants in the sector as perhaps we would have done.
Thanks for that. Right, and final question. There's been a lot of gloom and doom about recently for obvious reasons. Hopefully some of today's presentations will have given advisors hope that buy-to-let can be a positive and lucrative place to do business in the future. What words of wisdom would you have for today's audience that can help them succeed in the buy-to-let market? Can I put that question to you first, Adrian? Yeah,
look, buy-to-let is a predominantly intermediary market. We're going through a period of time where people need advice more than ever. They need to know about criteria, about products, what's out there, and it's a fast-moving market with a lot of changes. I think intermediaries have done a fantastic job during this period. I think we're starting to see some more normality in terms of lenders being out there and supporting this market. But keep close to your clients, but also keep close to the sales team that lenders such as ourselves and Phil's brands have, because we are here to support you. We want to work with you. And just keep on doing the good work that you're doing, because actually I'm pretty positive about the market and where it's come over the last several weeks since physical valuations in particular have come back.
Thank you, Adrian. And Phil?
Yeah, that's really nicely put. So a couple of things in summary. You've only got to look back to 2009 and lending falling off a cliff, and it appeared to be the end of the world. But the market bounced back incredibly quickly. We look back at 4 or 5 years ago, mortgage credit directive, tax changes, stamp duty changes. It's been through a whole raft of challenges, this market, and it always bounces back. From our own business perspective, and this isn't a plug for BM, you've got genuinely two really supportive lenders on this panel. We've just had a biggest month of the year, and the numbers are eye-watering, which just goes to show that there's a lot of business out there to be written, and we're keen to help brokers through this period.
Great stuff. Thank you both very much for joining me, and thank you everyone for watching. That's the end of our panel for today. Thanks again, guys, and goodbye.